Introduction. Something has quietly broken. Nothing about the US dollar looks broken at first glance. The markets are still open, prices are still quoted in dollars, paychecks still arrive, bills still get paid, and the headlines keep telling you that everything is under control. But beneath that surface, something fundamental has already shifted. The dollar hasn't collapsed in a dramatic, cinematic way. It has broken quietly, functionally, and almost invisibly. This is how monetary systems actually fail, not with alarms and warnings, but with subtle changes that only show up deep inside the plumbing of the financial system. What just happened wasn't designed for public attention. It didn't need your approval, and it didn't need your understanding. It was executed behind balance sheets, liquidity programs, and policy language most people never read. But its impact is real, and it's already reshaping the future value of money itself. Most people are still reacting to old signals. They're watching inflation numbers, interest rate headlines, and political debates, believing those are the real drivers. They're not. The real story is unfolding elsewhere, in decisions that permanently altered how the dollar functions, how risk is absorbed, and who ultimately pays the price. The most dangerous phase of any financial shift is the one where nothing looks wrong yet. History shows this clearly. By the time the problem becomes obvious to everyone, the consequences are already locked in. What you're seeing now is the calm before recognition, not the calm before recovery. And the people who understand that difference are already positioning themselves accordingly. The $9 trillion move explained what actually happened. What people call the $9 trillion move wasn't a single announcement or a dramatic overnight decision. It was the cumulative result of a series of actions that unfolded quietly across balance sheets, liquidity facilities, debt markets, and international capital flows. No press conference ever framed it this way, but taken together, these actions reshaped how the dollar system actually functions. This wasn't stimulus in the traditional sense, and it wasn't emergency policy either. It was a structural maneuver designed to keep the system operating under conditions it can no longer survive normally. At the center of this move was the expansion and repositioning of liabilities inside the U.S. financial system. When stress began building beneath the surface, the response wasn't to let markets clear naturally. Instead, liquidity was injected where it was most needed, often through mechanisms the public rarely hears about. Repo facilities, emergency lending windows, balance sheet guarantees, and off-market support programs were all expanded or reactivated individually. These tools looked technical. Collectively, they represented trillions of dollars in synthetic support. Debt rollovers were another critical piece. As interest rates rose, refinancing the national debt became mathematically unstable. Rather than allowing yields to spike and trigger a cascade of failures, maturities were quietly managed, absorbed, or redirected through institutional channels. Demand that should have disappeared was replaced. Risk that should have been priced was muted. This didn't eliminate the debt problem. It merely postponed its recognition by moving pressure from visible markets into institutional shadows. Backdoor bailouts played a central role as well. Instead of direct rescues that attract political backlash, support came through asset swaps, accounting flexibility, and selective liquidity access. Institutions that should have been forced to deleverage were given time. Losses that should have been realized were deferred. This wasn't charity, it was containment. The goal wasn't to restore health, but to prevent disorder long enough to manage exposure elsewhere in the system. Globally, capital flows began shifting in response. Foreign holders of U.S. assets became less willing to absorb new issuance at existing terms, rather than confronting this openly. Mechanisms were introduced to offset declining demand. Domestic institutions increased absorption, often indirectly. International swap lines expanded, allowing foreign central banks to access dollar liquidity without selling reserves. This stabilized appearances, while quietly increasing the system's dependency on continuous intervention. What makes this move significant is not just its size, but its coordination. These actions were not isolated responses to random problems. They were aligned. Liquidity support, debt management, and global coordination all moved in the same direction. Toward preserving function at the cost of integrity. The system was no longer being optimized for efficiency or stability. It was being optimized for survivability. Regardless of long-term consequences, this is where the number matters. $9 trillion represents the scale of intervention required to maintain the illusion of normalcy. It reflects how far the system has drifted from self-sustaining equilibrium. When a currency requires this level of continuous support, It stops behaving like money and starts behaving like infrastructure. It still works, but only as long as pressure is constantly managed. Importantly, this wasn't done to stimulate growth. Growth was never the objective. The objective was to prevent collapse under the weight of accumulated obligations. Inflation, asset bubbles, and distorted pricing were accepted as collateral damage. Stability in headlines mattered more than stability in fundamentals. The dollar continued to circulate, but its role subtly changed from store of value to transactional medium backed by policy force. Most people missed this because nothing appeared to break. Markets didn't freeze, banks didn't close, the system absorbed the shock quietly. That's precisely the point. When interventions become large enough, they prevent visible failure while guaranteeing invisible decay. The absence of panic was interpreted as success, even as the cost of maintaining calm increased dramatically. This wasn't an accident or a miscalculation. It was a deliberate choice between the outcomes: short-term disruption or long-term erosion. Policymakers chose erosion because it's slower, quieter, and politically survivable. But erosion compounds. Each intervention increases dependency, reduces flexibility, and narrows future options. The $9 trillion move marked the moment the system crossed from management into maintenance. From that point forward, the dollar didn't need confidence as much as it needed continuous support. And once a system reaches that stage, it can still operate for years, but it can no longer reset. It can only be sustained at increasing cost until something else breaks first. Why this move was necessary: the system was cornered by the time the $9 trillion intervention took shape. Policymakers were no longer choosing between good and bad options. They were choosing between bad and catastrophic. The public narrative framed recent decisions as proactive, strategic, and measured. In reality, the system had been cornered by forces that had been building for decades, finally converging at the same moment. What looked like confidence was actually constrained. The first pressure point was debt. Not just the size of it, but its structure. Decades of low interest rates encouraged governments, corporations, and consumers to borrow aggressively. That worked as long as rates stayed low. Once inflation forced rates higher, the math broke. Servicing existing debt began consuming an unsustainable share of revenue. Every new issuance compounded the problem. At a certain scale, debt stops being a tool and becomes a trap. That threshold had already been crossed. Rising interest costs exposed a second problem: refinancing risk. Large portions of government debt mature on predictable schedules, under normal conditions. Maturing debt is rolled over with minimal friction, but higher rates change the equation. Rolling over old debt at new rates dramatically increased costs. Allowing yields to rise naturally would have triggered a rapid feedback loop. Higher rates leading to higher deficits, which would then require even more issuance at even worse terms. That spiral could not be allowed to start. Foreign demand had already begun pulling back. For years, global buyers absorbed U.S. debt willingly, attracted by safety, liquidity, and yield. But persistent deficits, political dysfunction, and currency debasement altered that calculus. Central banks diversified. Sovereign funds reduced exposure. Demand didn't disappear overnight, but it weakened steadily. When marginal buyers step away, pricing power vanishes. The system became increasingly dependent on artificial demand. Domestic absorption filled part of the gap, but only with assistance. Banks, funds, and institutions increase holdings, often under regulatory pressure or liquidity incentives. This wasn't organic confidence, it was managed participation. Without support, balance sheets would have strained. With support, risk was masked rather than removed. The system functioned, but only because it was being held together. Inflation complicated everything. Officials insisted inflation was easing, pointing to selective indicators. But beneath those metrics, costs remained elevated and purchasing power continued eroding. Inflation wasn't being defeated, it was being redistributed. Instead of showing up as consumer price spikes, it emerged as asset inflation, fiscal expansion, and balance sheet growth. The messaging suggested control. The reality reflected survival. This is where the contrast becomes clear. Publicly, the narrative emphasized strength and resilience. Privately, decisions reflected urgency. Liquidity facilities were expanded, not because conditions were healthy, but because stress was accelerating. Emergency tools became routine. Temporary measures lost their expiration dates. Each extension signaled the same truth: removing support would expose instability. The system could no longer absorb. Another constraint was political. A disorderly reset would have immediate consequences: market crashes, bank failures, and unemployment. Spikes would be impossible to contain. The social and political fallout would be severe. No administration wants to preside over that kind of rupture. Quiet intervention, even at enormous scale, was the path of least resistance. It delayed consequences without forcing accountability. There was also the issue of timing. Multiple pressures converged simultaneously: high debt, rising rates, weakening foreign demand, aging demographics, and slowing growth. Addressing any one of these in isolation would have been difficult. Addressing all of them at once was impossible. The system lacked the flexibility to absorb even a moderate shock. Intervention became the default response because inaction was no longer viable. Critically, this move was not about restoring normal conditions. Normal was no longer achievable. It was about maintaining functionality. Payments needed to clear. Markets needed to open. Confidence needed to appear intact. These are operational goals, not structural solutions. They prioritize continuity over correction. This is why the scale matters. Smaller interventions would have failed. Incremental adjustments would have exposed fragility. The size of the response reflected the size of the underlying problem. When support reaches trillions, it signals that the system cannot self-correct without collapsing parts of itself. The decision to act was framed as leadership. In reality, it was containment. Losses were deferred, imbalances were preserved. Future flexibility was sacrificed for present calm. This wasn't strength. It was necessity. History shows that systems reach moments where choices disappear. At that point, actions become reactive rather than strategic. The $9 trillion move belongs in that category. It was executed because the alternative was immediate disorder, not because it promised long-term stability. This is why the move matters more than the messaging around it. It reveals the true condition of the system. When survival requires constant intervention, the system is no longer resilient, it is dependent. And dependency changes everything about how money behaves, how risk is priced, and how power is exercised. They told you inflation was cooling. What they didn't say was that the system itself was overheating under the weight of its obligations. This move wasn't made to protect prosperity. It was made to keep the machinery running a little longer, even as the cost of doing so quietly reshapes the future. How this quietly broke the US dollar. When people hear the phrase, "the dollar is broken," they imagine dramatic scenes: hyperinflation, wheelbarrows of cash, empty store shelves, currency charts collapsing in real time. But that isn't how reserve currencies actually fail. They don't break loudly, they erode quietly, invisibly at first, until the damage is irreversible. What happened with this $9 trillion move didn't destroy the dollar overnight. It changed the rules that gave the dollar credibility in the first place. A currency is not just paper or digits on a screen. It is a system of trust. Trust that the uni will hold purchasing power over time. Trust that obligations denominated in it can be honored without manipulation. Trust that it is governed by rules, not desperation. Once that trust begins to decay, the currency still functions, but only mechanically. It works because people are used to using it, not because they believe in it. That is where the dollar is now. It hasn't collapsed. It has slipped into a credibility deficit. And credibility, once lost, is almost impossible to recover. The first fracture is purchasing power. Official inflation numbers never tell the full story. They smooth volatility, adjust baskets, and emphasize averages. But lived experience tells a different truth. Housing, healthcare, education, insurance, energy, and food have all risen faster than wages for years. Even when headline inflation slows, the price level doesn't reset, it locks in. Each intervention that expands liquidity pushes that baseline higher. The dollar buys less not because of a sudden crisis, but because of a long series of temporary fixes. The second fracture is predictability. Reserve currencies earn their status by being boring, stable, unexciting. Markets can plan around them. When massive interventions become routine, predictability disappears. If rules can be suspended whenever stress appears, then pricing risk becomes impossible. Investors are forced to assume future dilution. That assumption embeds itself into every long-term decision. At that point, the currency is no longer a neutral medium. It becomes a variable. This is where historical patterns matter. Spain did not lose the real because inflation suddenly exploded. It lost it because silver inflows destabilized prices and incentives. The Dutch did not lose the guilder because of one banking failure. They lost it because confidence in financial integrity eroded. Britain did not lose the pound because of one devaluation. It lost it because repeated interventions revealed weakness, not strength. In every case, the currency continued circulating long after it was fundamentally compromised. Reserve Currencies collapse into phases. First comes the slow phase. Usage remains high, trade continues, confidence weakens quietly. Foreign holders diversify prudently, institutions rebalance risk, nothing looks dramatic. Then comes the sudden phase. A shock hits. It could be geopolitical, financial, or social at that moment. The accumulated loss of trust expresses itself all at once. Liquidity vanishes. Pricing gaps appear. The currency reprices violently. The dollar is deep into the slow phase. Its dominance now relies more on inertia than conviction. Global trade still uses dollars because systems are built around it. Debt is still denominated in dollars because alternatives are inconvenient. Reserves still hold dollars because exiting them quickly would be destabilizing. But these are structural frictions, not endorsements. They delay change. They do not prevent it. The $9 trillion maneuver accelerated this process by signaling something critical. Constraints no longer matter. When markets realize that balance sheets will always expand to prevent pain, they adjust behavior. Risk is no longer priced honestly. Losses are socialized. Gains remain private. Over time, this creates an asymmetric system where holding the currency itself becomes the risk. Another layer of breakage is international perception. Reserve status depends on external confidence more than domestic belief. Foreign governments and institutions don't vote, they calculate. When they see a system that must constantly intervene to function, they reassess exposure. Not because collapse is imminent, but because optionality matters. Diversification becomes a rational response. Each reduction is small, each decision is defensible. Collectively, they matter. This is how trust decays, not through panic, but through optimization. Each actor acts in their own interest. No one announces a vote of no confidence. They simply adjust portfolios. Over time, demand weakens. Support must increase. The cycle feeds itself. Importantly, this is not about hyperinflation. Hyperinflation is a political failure layered on top of monetary collapse. The United States may never experience it. It doesn't need to. A reserve currency does not require hyperinflation to fail. It only requires sustained debasement combined with credible alternatives. Those alternatives don't need to be perfect. They just need to exist. The dollar's strength has always rested on three pillars: trust, scarcity, and discipline. Trust is eroding as interventions grow. Scarcity disappears when supply expands without constraint. Discipline fades when every downturn is met with emergency tools. Remove any one pillar and the structure weakens. Remove all three and the currency becomes performative. What makes this moment dangerous is that nothing looks broken on the surface. Markets still trade. A team is still work. Paychecks still clear. That is precisely how every previous reserve currency failure looked before the inflection point. Normalcy is not evidence of health. Sometimes it is evidence of denial. The dollar now operates on borrowed credibility. It functions because people expect it to function. That expectation holds until it doesn't. When confidence finally shifts, it won't announce itself politely. It will move through markets faster than narratives can catch up. This is what broken really means. Not destroyed, not collapsed, but fundamentally altered. A currency that still exists, still dominates, still circulates, yet no longer rests on the foundations that made it stable. At that point, the future path narrows. Adjustments become larger, interventions become more frequent, and every attempt to preserve stability pulls more credibility forward from the future. Slow, then sudden is not a slogan, it is a mechanism, and the slow part is already well underway. Why this can't be reversed? The point of no return. Every financial system reaches a moment where reversal is no longer a matter of intelligence, discipline, or political will. It becomes a matter of mathematics. That is where the United States is now. The reason this situation cannot be reversed is not because leaders are incompetent or malicious, but because every available option makes at least one critical variable worse. There is no clean exit, only trade-offs, and every trade-off accelerates the same outcome. Start with the debt math, because this is the immovable object. The United States is carrying debt levels that no longer behave linearly. When debt was small, growth could outpace it. When debt grew larger, low interest rates could mask it. But once debt crosses a certain threshold, interest itself becomes the dominant expense. That threshold has already been crossed. The government now pays more in interest than on national defense. This is not a temporary spike, it is structural. Raising interest rates does not solve this. In fact, it makes it worse almost immediately. Every percentage point increase translates into hundreds of billions of dollars in additional annual interest costs. Those costs must be funded by issuing even more debt. So the attempt to restore discipline through higher rates paradoxically accelerates the very problem it is meant to fix. This is the debt trap, and once inside it, exits disappear. Lowering rates doesn't solve it either. Lower rates reduce interest pressure, but they require more liquidity, more credit creation, and more balance sheet expansion. That weakens the currency and fuels asset inflation. It may stabilize markets temporarily, but it deepens long-term instability. Growth that comes from cheap money is not real growth. It is pulled forward from the future. When that future arrives, the bill comes due. This is where demographics enter the picture. A younger population can grow its way out of debt and aging. One cannot. The United States is aging rapidly. Millions of retirees are drawing benefits while fewer workers support them. Healthcare costs rise faster than GDP. Entitlements expand automatically. These are not policy choices that can be easily reversed. They are promises already made and politically untouchable. Any attempt to meaningfully cut them would trigger immediate social and political crisis. At the same time, the labor force participation rate remains structurally lower than it was decades ago. Productivity growth is uneven. Wage growth lags asset growth. This creates a vicious cycle where consumption depends increasingly on credit rather than income. That credit must be supplied by the same system already drowning in debt. The economy becomes dependent on financialization rather than production. That is not a foundation for reversal. Then there is political paralysis. Reversal would require coordinated long-term sacrifice, higher taxes, lower spending, reduced benefits, slower growth, and a willingness to tolerate market pain. No modern democracy is built to deliver that. Election cycles reward short-term relief, not long-term repair. Any politician who seriously proposed austerity on the scale required would be removed almost instantly. The system self-selects for delay, even when there is consensus that a problem exists. There is no agreement on who should bear the cost. Tax the wealthy, and capital flees. Cut spending, and voters revolt. Inflate the debt away, and savers are punished. Every path redistributes pain, and redistribution always creates resistance. So policymakers choose the only option that appears painless in the moment: postpone the cost. That postponement requires intervention. Intervention requires liquidity. Liquidity requires currency expansion. Currency expansion weakens trust. Trust is the foundation of reserve status. This is the loop that cannot be escaped. Global dynamics make reversal even less possible. For decades, the dollar benefited from the absence of alternatives. That era is ending. Not because a single rival currency is superior, but because a fragmented system is emerging. Trade agreements increasingly bypass the dollar. Payment systems diversify. Central banks reduce dollar exposure incrementally. None of this needs to replace the dollar outright. It only needs to reduce marginal demand. Reserve currencies fail at the margin. They don't need everyone to leave. They only need enough participants to hedge. Once that process starts, it feeds on itself. Reduced demand forces increased issuance. Increased issuance accelerates diversification. This feedback loop does not reverse naturally. It must be interrupted by restored credibility. But credibility cannot be restored without discipline. And discipline would collapse the system that depends on intervention. Some argue that innovation will save the system. Artificial intelligence, automation, productivity gains, these forces are real. But they do not solve sovereign debt problems. Innovation increases output, but it does not automatically reduce obligations. In many cases, it increases inequality and concentrates gains, worsening political stress. Technology cannot erase arithmetic. Others argue that America's military power guarantees the dollar. History does not support this. Spain had military dominance. Britain controlled global trade routes. Force can secure resources, but it cannot force trust. Reserve currency status is voluntary. It exists because holding the currency is beneficial, not because it is coerced. Once the benefits erode, power cannot compel confidence. There is also the illusion of control, the belief that central banks can fine-tune outcomes indefinitely. In reality, their tools are blunt. They influence liquidity, not productivity. They manage symptoms, not causes. Each intervention distorts signals. Over time, markets stop responding normally. Risk is mispriced. Volatility compresses, then explodes. At that stage, control becomes performative. The point of no return is not a date on a calendar. It is a condition. It is the moment when fixing the problem would cause more damage than letting it continue. That moment has already passed. Any serious attempt to normalize rates, shrink balance sheets, or restore fiscal discipline would trigger cascading defaults across governments, corporations, and households. The system would not survive the cure. So instead, the strategy becomes containment, manage volatility, extend maturities, roll debt forward, redefine inflation, adjust metrics, encourage optimism. None of this reverses the trajectory. It only smooths the surface while pressure builds underneath. This is why every path forward makes the problem worse. Tightening breaks the debt structure. Easing breaks the currency. Doing nothing breaks confidence. There is no fourth option. Policymakers are not choosing between good and bad outcomes. They are choosing between bad and worse, repeatedly, until choice itself disappears. What remains is time. Time bought through credibility borrowed from the future. Each intervention pulls that future closer. Each delay increases the scale of the eventual adjustment. This is not pessimism. It is how closed systems behave under compounding constraints. The system will not announce that it has crossed the point of no return. It will continue to function. Markets will rally. Data will improve temporarily. Narratives will shift. That is exactly what happened in every historical case. The absence of collapse is used as proof of stability, right up until the moment stability vanishes. Reversal requires a reset. Resets are politically impossible until they are unavoidable. And when they become unavoidable, they are no longer controlled. They are imposed by reality. That is the core truth. This situation persists not because it is sustainable, but because it is unavoidable in the short term and unfixable in the long term. The system is not heading toward reversal. It is heading toward resolution, and resolution, by definition, is not gentle. This is the point of no return. Not because disaster is imminent tomorrow, but because the structural conditions that would allow genuine repair no longer exist. From here forward, every solution is temporary, every fix is cosmetic, and every delay increases the magnitude of what comes next. That is why this cannot be reversed, not by policy, not by politics, not by innovation. The math has already closed the door. Smart money's silent exit from the dollar system when capital leaves a system. Before a major transition, it never does so dramatically. There are no press conferences, no emergency announcements, no headlines that say, "We're getting out." That kind of behavior would collapse markets instantly and damage the very portfolios trying to protect themselves. Instead, smart money exits quietly, methodically, and patiently. That is exactly what is happening to the dollar system right now. The most important thing to understand is this: smart money does not predict collapse. It prices risk, and when risk begins to outweigh reward, exposure is reduced. Not eliminated overnight, but reshaped, rebalanced, hedged, spread out. That process is already well underway. Start with sovereign actors, because they move first and they move largest. Central banks around the world have been steadily reducing their reliance on U.S. treasuries. Not dumping them, not panicking, but allowing bonds to roll off without full reinvestment. Small percentage reductions year after year may seem insignificant, but at the scale of trillions, they matter enormously. This is not ideological, it is defensive. Concentration risk is no longer acceptable when the issuing country is running persistent deficits and monetizing debt. At the same time, reserve diversification is accelerating. Gold purchases by central banks have reached levels not seen in decades. These are not speculative trades, they are balance sheet decisions. Gold carries no counterparty risk. It cannot be sanctioned, frozen, or diluted when central banks increase gold holdings while reducing dollar exposure. They are sending a signal, not of collapse, but of mistrust. Sovereign wealth funds are following a similar path. These funds exist to preserve national wealth across generations. They think in decades, not quarters. Over the past several years, they have been shifting capital away from U.S.-centric assets and toward global infrastructure, energy, commodities, and real assets in politically neutral jurisdictions. Again, this is not anti-American sentiment. It is risk management in a world where the rules are changing. Then there are institutions, pension funds, endowments, insurance companies. These entities are highly constrained. They cannot speculate. They must meet future obligations. When they rebalance, it is based on long-term assumptions. What we are seeing is not a mass exodus, but a steady recalibration. Lower allocations to long-duration dollar-denominated bonds, increased exposure to inflation-resistant assets, more international diversification, more emphasis on optionality. Asset managers play a critical role here. The largest firms in the world shape flows simply through allocation guidance. When they quietly adjust models to assume lower real returns for U.S. bonds and equities, trillions of dollars follow those assumptions not because anyone is panicking, but because fiduciary duty demands adaptation. This is how capital moves without drama. Currency hedging is another major signal. Institutions that once left dollar exposure unhedged are now actively protecting against dollar weakness. Hedging costs money. No one does it unless they believe the risk justifies the expense. Rising hedge ratios indicate that confidence in long-term dollar stability is weakening, not gone, but no longer taken for granted. Geographic diversification tells the same story. Capital is flowing into regions that offer political stability, resource security, and favorable demographics. Asia, parts of Europe, select emerging markets, not as replacements for the United States, but as complements. The goal is not to abandon the dollar system. It is to avoid being trapped inside it. What makes this moment unique is the contrast between public behavior and institutional behavior. The average individual remains heavily concentrated in dollar-denominated assets, cash, savings accounts, retirement funds, domestic real estate. This is not because individuals are foolish. It is because they are structurally limited. Their lives are denominated in dollars. Their incomes are paid in dollars. Their liabilities are in dollars. Changing that requires knowledge, access, and flexibility most people do not have. Smart money has all three. It has information earlier, it has access to global instruments, and it has the flexibility to move gradually without disrupting daily life. That asymmetry exists in every historical transition. The public reacts after the fact. Institutions position before it becomes obvious. Another key signal is what smart money is not doing. It is not aggressively increasing exposure to long-term U.S. debt despite rising yields. If yields were truly attractive relative to risk, demand would surge. Instead, demand is tepid and increasingly domestic. The government and central bank are absorbing more of their own issuance. That is not a sign of confidence. It is a sign of necessity. Even within the equity markets, behavior is shifting. Capital favors companies with global revenue streams, pricing power, and real assets over purely financial engineering. There is less appetite for growth that depends entirely on cheap liquidity. More emphasis on resilience. That shift reflects an environment where money is no longer assumed to be stable. Importantly, none of this requires a belief that the dollar will collapse tomorrow. Smart money does not need certainty. It only needs asymmetry. If the upside of holding concentrated dollar exposure is limited while the downside is growing, the rational move is to reduce that exposure. That logic compounds across portfolios. This is how systems change without headlines. Each individual decision is small, each adjustment is defensible, but together, they reshape the financial landscape. The dollar system does not break because everyone leaves. It weakens because enough participants stop adding. What makes observers uncomfortable is the silence. There is no official acknowledgement, no coordinated statement, just data points scattered across filings, balance sheets, and allocation reports. To those who know how to read them, the message is clear. To those who rely on headlines, it is invisible. This is why early observers matter. Understanding these signals does not mean abandoning the system. It means recognizing where incentives are shifting. Smart money is not betting against the dollar. It is betting against concentration. It is betting against complacency. It is betting that optionality will be more valuable in the future than certainty. Every reserve currency transition looks like this in the middle. Confusing, quiet, uneventful on the surface. The public asks, if this were real, wouldn't it be obvious? History answers that question very clearly. It never is. Until it is. By the time exits become loud, positioning is no longer possible. Prices adjust. Liquidity disappears. Options shrink. The advantage belongs to those who recognize the pattern during the silent phase. That is the phase we are in now. The dollar system is still dominant, still functional, still powerful. But the smartest participants are no longer treating it as permanent. They are acting accordingly. And they are doing it without asking for permission or drawing attention. This is not panic. It is preparation. And preparation always looks boring before it looks brilliant. What this means for ordinary people: the hidden costs. Large financial shifts are often discussed in abstract terms, trillions of dollars, balance sheets, global flows, but the real cost of these changes never shows up in press releases or policy statements. It shows up in daily life, quietly, gradually, in ways that are easy to dismiss at first and impossible to ignore later. For ordinary people, this transition is not about markets collapsing. It is about standards of living eroding. The most immediate impact is on purchasing power. When liquidity expands to stabilize systems, prices adjust upward over time, not evenly. And not all at once. Essentials rise first: housing, food, energy, healthcare. These are not optional expenses. They consume a larger share of income each year. Even when official inflation numbers suggest moderation, wages rarely keep pace because wage growth is constrained by productivity and competition. The gap between income and cost of living widens. Slowly, then persistently, this creates the illusion of progress. Paychecks may increase nominally. Accounts show larger numbers, but what those numbers can buy shrinks. This is not an accident. It is how debt-heavy systems transfer costs without visible taxation. Inflation functions as a silent fee on cash and fixed income. It is paid by those least able to avoid it. Savings are the next casualty. Traditional savings vehicles are designed for stability, not protection. When interest rates lag real inflation, savers lose purchasing power every year. This is not theoretical, it compounds. Money set aside for emergencies, education, or retirement quietly decays. The longer the transition lasts, the more severe the loss becomes. Pensions face a similar problem. Many retirement systems are built on assumptions that no longer hold. They assume stable returns, predictable inflation, and reliable funding. When markets require constant intervention to function, those assumptions break. Funds are forced into riskier assets to meet obligations. That increases vulnerability in extreme cases. Benefits are reduced, delayed, or restructured. Retirees bear the cost of decisions they did not make. Salaries are affected in more subtle ways. Employers operate within the same system. Rising input costs, volatile financing conditions, and uncertain demand pressure margins. Wage increases become harder to sustain. Job security weakens. The labor market may appear strong on the surface, but beneath it, flexibility declines. Workers are asked to do more for less, justified by economic conditions that feel vague and uncontrollable. Home ownership, long considered a path to stability, becomes distorted. Asset inflation pushes prices beyond affordability. Those who already own benefit on paper. Those trying to enter face higher barriers. Higher interest rates compound the problem by increasing monthly payments. The result is a generational divide. Wealth accumulates through ownership, while renters absorb rising costs with no equity to show for it. Healthcare and education amplify these pressures. Both sectors are highly sensitive to inflation and financing conditions. Costs rise faster than general inflation, while quality improvements lag. Families are forced to make trade-offs. Delay care, accumulate debt, accept long-term financial strain for short-term necessity. These decisions are not framed as consequences of monetary policy, but they are. The emotional toll is significant. People sense that something is wrong, even if they cannot articulate it. They work harder but feel poorer. They save more but fall behind. Trust in institutions erodes. Cynicism replaces optimism. This is not because individuals have failed. It is because the system has shifted burdens downward. Importantly, none of this requires crisis headlines. That is what makes it dangerous. When change is gradual, it is normalized. Each year feels only slightly worse than the last. Expectations adjust downward. What once felt unacceptable becomes routine. That adaptation masks the true scale of loss. This is where the phrase "you didn't vote for this, but you're paying for it" matters. These outcomes are not the result of individual choices. They are structural. They arise from decisions made to stabilize systems at the top, by distributing cost across millions of people. At the bottom, no single policy appears catastrophic. Together, they reshape society. Another hidden cost is reduced opportunity. When capital is misallocated to sustain existing structures, less is available for productive investment. Innovation slows, small businesses struggle, entry barriers rise, economic mobility declines. The system becomes more rigid. That rigidity benefits incumbents and disadvantages newcomers. Debt becomes a coping mechanism. Households borrow to maintain lifestyles. Credit fills gaps that income no longer covers. This creates vulnerability. Rising rates increase servicing costs. A small disruption becomes a crisis. Financial stress becomes widespread, even among those who appear stable. Social cohesion suffers as well. Economic pressure breeds resentment. Groups blame each other. Political polarization intensifies. These are not side effects. They are symptoms of prolonged economic strain. History shows that monetary transitions are rarely neutral. They reshape relationships between citizens and institutions. It is important to be clear. This is not about fear. It is about recognition. Understanding the hidden cost allows individuals to respond rationally rather than react emotionally. The worst outcomes occur when people are surprised, when systems change slowly. Awareness is the only defense. Ordinary people are not powerless, but they are exposed. The system's adjustment is being financed through their purchasing power, their savings, and their future earnings. This transfer is not labeled, it is embedded. And because it is embedded, it is rarely challenged. What makes this moment critical is timing. The earlier someone recognizes the pattern, the more options they retain. Later, options narrow. Costs rise. Flexibility disappears. This is not about predicting collapse. It is about understanding direction. You did not design this system. You did not authorize these trade-offs, but you live inside them, and whether or not it is acknowledged. The cost of maintaining stability at the top is being paid quietly by those below. That is the hidden cost, not sudden ruin, but sustained pressure. Not visible theft, but gradual erosion. And it continues until enough people recognize that the system has changed, even if it still looks the same on the surface. What happens next? The slow unfolding phase. When people imagine systemic change, they expect a moment, a date, a headline. That signals the end of one era and the beginning of another. That is not how financial transitions unfold. They move in phases, slowly at first, unevenly, often disguised as normal volatility. What comes next for the dollar system is not a single event, but a process that stretches across months and years, marked by confusion rather than clarity. The next phase is best understood as prolonged instability. Markets will continue to function, but their behavior will feel increasingly disconnected from fundamentals. Sharp rallies will follow sharp declines. Good news will be ignored. Bad news will be dismissed. Price movements will appear irrational because liquidity, not value, will dominate outcomes. This is not a breakdown. It is a symptom of a system trying to maintain balance without stable anchors. Policy confusion will intensify. Central banks will oscillate between tightening and easing, often within short time frames. Inflation metrics will improve in some areas while worsening in others. Officials will speak confidently while contradicting previous guidance. This is not incompetence. It is the result of conflicting objectives. Stabilize markets, protect employment, control inflation, service debt. These goals increasingly conflict. Choosing one worsens the others. Asset bubbles will not disappear, they will rotate. When one sector cools, liquidity will seek another outlet. Real estate may stall while equities surge. Commodities may spike while bonds struggle. These shifts will be framed as normal cycles, but their frequency will increase. Bubbles become harder to identify because everything feels inflated relative to history. Social tension will rise subtly. Economic stress rarely erupts immediately, it simmers. Trust in institutions declines further. Public discourse becomes more polarized. Narratives compete to explain why life feels harder despite technological progress. This tension feeds back into markets through political uncertainty and policy risk. Importantly, there will be periods of apparent calm. Data will improve, markets will stabilize, confidence will return briefly. These moments will be used as proof that concerns were exaggerated. Historically, these interludes are the most dangerous because they encourage complacency. Each recovery reinforces the belief that the system has healed, when in reality it has only postponed adjustment. Internationally, fragmentation will continue. More trade will be settled outside the dollar. Alternative payment systems will expand. Quietly, none of this will replace the dollar outright. It doesn't need to. Each incremental shift reduces demand marginally. Over time, marginal changes become structural. For individuals, this phase feels exhausting. Planning becomes difficult. Long-term decisions carry more uncertainty. Financial advice becomes contradictory. The sense of control diminishes. This psychological toll is part of the process. Systems under strain transmit stress downward. What will not happen is a clean reset. No official announcement, no single policy fix. Transitions of this scale resolve through accumulation, not decision. The slow unfolding phase is defined by ambiguity. That ambiguity persists until a catalyst forces resolution. The purpose of understanding this phase is not to predict exact outcomes, but to recognize patterns. Stability will feel less stable. Risk will feel harder to price. Trust will continue to erode incrementally. These are signals, not alarms. Collapse, when it comes, is rarely a surprise to those paying attention. It is a confirmation of trends already visible. Until then, the system grinds forward, adapting just enough to survive. This is the slow unfolding, not dramatic, not cinematic. but consequential, and recognizing it early preserves agency in a world that is quietly changing direction. Final message: awareness is the only advantage left by this point. One thing should be clear: this isn't about predicting dates, crashes, or dramatic endings. It's about understanding where we are in the life cycle of a system. The most dangerous phase is not collapse, it's the phase before it, when everything still appears functional enough for people to ignore what's changing underneath. That's where we are now. Fear is not the right response here. Panic doesn't create clarity, it destroys it. The real shift that needs to happen is internal. It's the moment you stop taking official narratives at face value and start observing incentives, patterns, and constraints. When you do that, the noise fades. What's left is a system behaving exactly the way strained systems always do. Awareness doesn't mean you suddenly gain control over global finance. You don't. No individual does. But awareness changes your position inside the system. It moves you from passive participant to informed observer. And that difference matters more than people realize. Most losses don't happen because people were uninformed. They happen because people were informed too late. There is a small window in every long transition where understanding itself is on edge, not because it makes you richer overnight, but because it prevents you from making decisions based on outdated assumptions. The biggest risk right now is assuming tomorrow will function like yesterday, simply because it still mostly does today. You're not being asked to abandon the system. That's unrealistic. You live inside it. You work inside it. You transact in it. The goal is not rejection. The goal is adjustment. Quiet, rational adjustment based on reality rather than reassurance. That's what institutions do when they sense structural change. They don't announce it. They adapt. This is where most people get stuck. They wait for certainty. They want confirmation in the form of headlines, consensus, or official acknowledgement. But systems don't give warnings when they're cornered. They give rationalizations. By the time certainty arrives, flexibility is gone. Options narrow. Costs rise. Awareness keeps options open longer. It changes how you think about risk, savings, time horizons, and exposure. It encourages diversification of thought before diversification of assets. It slows impulsive reactions and sharpens long-term judgment. Those are quiet advantages, but they compound. There's also a psychological shift that happens when you truly understand what's unfolding. You stop feeling confused by contradictions. You stop being surprised by policy reversals. Volatility no longer feels random. It feels structural. That alone reduces anxiety. Uncertainty is far more tolerable when it's contextualized. This isn't about believing the system will end tomorrow. It's about accepting that it cannot return to what it was. That distinction matters. Many people are still waiting for a reset back to normal. That normal required conditions that no longer exist. Low debt, favorable demographics, global trust, and policy flexibility. Those conditions are gone. What replaces them will not look familiar. Being early to that realization doesn't make you extreme. It makes you aligned with reality. History shows that transitions are always understood by a minority before they're acknowledged by the majority. That gap is where awareness lies. Not privilege, not insider information, just perspective. You don't need to convince anyone else. In fact, trying to often backfires. Awareness is personal. It shapes your decisions quietly. The system doesn't reward those who shout the loudest. It rewards those who adapt earliest. The final mistake people make is thinking awareness should feel empowering in a dramatic way. It doesn't. It feels sobering, grounding, sometimes uncomfortable, but over time, it restores a sense of agency that blind optimism can't provide. You stop outsourcing judgment. You start trusting analysis over assurance. The system will continue to move forward. Policies will change. Narratives will shift. Volatility will come and go. None of that requires your permission. What you do control is whether you're surprised by it or prepared for it. You can't stop what's already in motion. No one can, but you can stop being blindsided by it. And in a system built on inertia, that awareness is the last real advantage left.